Hi everyone, my name's Melinda and I am a tax partner and head of the tax team at McCullough Robertson Lawyers in Brisbane. Together with Damien and Scott, I'm here to talk you through some of the tax consequences that might be associated with the ownership and transfer of assets, both whilst during your lifetime and maintaining control of those assets and ensuring that the income goes to the correct persons, but also upon death and making sure that those assets are transferred appropriately pursuant to your will and minimising the tax payable where possible. I thought I would keep it fairly high level in terms of tax today because it can get quite complicated. But what I thought I would talk about was the different circumstances where assets might be transferred in circumstances where you die. If you're looking to transfer assets before you die, you might want to transfer the assets to your kids so they don't form part of your estate. What I would say about that is it's absolutely possible to do that with proper planning, but any transfer or disposal of assets that happens before you die, so that doesn't transfer pursuant to your will trigger tax consequences potentially. So we are looking at a potential tax liability in respect of disposing of assets prior to death. So what are our options? There are a number of alternatives. In terms of looking to transfer assets to your estate, so if you make provision in your will to transfer assets pursuant to estate, you'll be looking at, if assets are owned in entities, transferring control of the relevant entities to the relevant people. So if it's your children, you'll be looking to maintain the control of those entities and passing that to your kids. But if you're looking at assets that you own in your own name, you're wanting to make sure that those assets can be transferred tax effectively through your will. Generally, there will not be any tax payable on the disposal of assets that has to happen upon your death from your own name to the trustee or to your legal personal representative of your estate. There's no tax recognised in those circumstances and it's sort of treated as a deferral of CGT. Generally, where assets are post-CGT assets, so they've been acquired since September 1985, those assets are treated as a continuation. So once they transfer to your legal personal representative and then to the beneficiaries under your will, there's no tax triggered as a result of the transfer of those assets, and your beneficiaries will generally just acquire those assets and they'll be deemed to hold them on essentially the same terms as you did. So with the same cost base, and if the assets are sold in future, then they would pay the tax at that time, similar to the way that you would if you were to dispose your assets prior to death. The other alternative that you can look at, looking to transfer assets to, for example, a trust established under your will for certain beneficiaries. This can be a really great option, particularly in terms of making sure that, for example, if you've got units in a Sentinel fund, that those units can pass to the testamentary trust, which can be controlled by a child who will benefit under your estate, and that allows the income from those units to then be distributed over time to the child, but also to all of the other eligible beneficiaries of that trust. The benefit of doing so is that ordinarily, in a normal family trust, when we distribute income to, for example, minors, there's penalty rates that can apply to that because we're trying to discourage the splitting of income between different entities and the ability for minors to access those marginal tax rates. So there's a penalty rate that applies to that income. Under a testamentary trust, and for assets that are settled on that trust pursuant to the will, that income is not captured by those provisions. So what it means is that it gives us a greater flexibility in terms of distributing that income to minors, so to your grandchildren, to your children, and to a broader range of beneficiaries of the testamentary trust. So it gives them a little bit more control. It also gives them an ability to realise the value of the investment and realise that income stream over time and building wealth for them into the future. The last item I wanted to just touch on is assets held in superannuation. When you die, often you will have made a binding death benefit nomination in respect of your interest in a self-managed super fund or a regulated super fund. Often then the super fund or the value of your membership interest in the fund will pass to the person nominated in your binding death benefit nomination. You can nominate the trustee of your trust. You can nominate the legal personal representative of your estate as the recipient of the binding death benefit nomination, but there can be tax consequences of doing so. If my superannuation benefits pass to what they call a dependent, then that's tax-free when they receive those benefits directly from the super fund. Once it goes under a binding death benefit nomination to my estate, we need to look at who's going to receive the benefit of those funds ultimately in my estate and whether that's going to be a dependent of mine or not. So that can complicate the tax treatment a little bit. What I will say is also there is an ability, particularly in a self-managed superannuation fund context, for the fund to make an in-specie distribution of property pursuant to the binding death benefit nomination. So if you've got assets held in your self-managed super fund, and they might comprise units in a settlement fund, for example, but it could be any other type of asset as well, a property asset, for example. Those assets don't necessarily need to be sold and cashed out so that your superannuation balance can be transferred pursuant to your binding death benefit nomination. It is possible to transfer those assets in specie if it's considered appropriate to do so. But there are potentially tax consequences again of doing so. So because the super fund is actually disposing of those assets to the recipient, there can still be capital gains tax and other consequences like stamp duty in respect to the transfer of those assets in specie. So in summary, I think there are a lot of tax consequences to consider when you're making an appropriate estate plan and also ensuring the proper ownership of your assets in the most tax effective way from the outset. There's a lot of things that play into it, and it means that it is important to think about the consequences and how assets might be transferred as part of that estate planning process.